Broadcast is now starting. All attendees are in listen-only mode.
Hello everybody, welcome to join our Let's Learn Futures webinar series. And this derivative webinar series is brought to you by Bursa Malaysia as part of the educational initiative. Alright, and today we are going to talk about risk management. Okay, have you ever felt that risk management is one of the most important things in trading futures? If yes, then this is the best time for you to learn about risk management from our expert resource speaker today, which is CC Yong. All right, thank you for joining our webinar today, CC.
Hey.
All right, so as usual, disclaimer: whatever we share in this webinar is only for educational purpose. In no way that the speaker or a company or Bursa Malaysia derivative give you any buy or sell signal for you to long or short any futures contract. So if you decide to do that, you do it at your own risk. So we have planned a whole year of Bursa derivative webinars, and now is our 11th Bursa derivative webinar, and today we talk about risk management. And in the next webinar, which is scheduled on 22nd of August, we are going to talk about psychology in trading in the futures market. All right, so if you after learning about risk management, when you want to learn how you can maintain a good state of mind in trading in the futures market, please join our next futures webinar. All right, so allow me to introduce our speaker. And if you have followed our webinar series, you may have heard him speak a few times. So his name is CC Yong. He's a full-time trader. He's a local participant of Bursa Malaysia Derivative. It means that he has traded at least 1,000 lots every month, right? And he's also a founder of Straits Index Sdn Bhd, which is a proprietary trading company and also an associate participant of Bursa Malaysia Derivative. And he has a vast experience in trading because he himself look at the futures market day in and day out. Okay, he sees the market every day and he trades every day. And we are very glad to have you on board with us today to share your experience with us on how you do risk management. So over to you, CC. Okay, I just made you a presenter. I just made you a presenter.
Oh. Okay. Can you hear me?
Yes, we can hear you.
Okay. Because just like I can't hear anything. Okay. Right. So you see my screen now?
Yeah, we see your screen, but we lost your webcam.
Oh, really? Okay. I think there's some technical difficulty.
Yeah.
Okay.
Got some technical error.
Okay.
Okay, yeah.
Can you see my?
I can see your webcam now.
Okay. The slide you can see also, eh?
Yes, can see your slide. Go ahead.
Okay, right. So I think I just disconnect or some troubles connecting. Right. Good evening, everybody. Let's not further ado. Okay. Thanks, Chen Chen, for the introduction. So I think, Rafi, you know where I am. So today, the topic is on trading futures on the risk management subtopic, and I like to talk about this topic because this is one of the topic usually I talk most, and I would like either my students, my audience to really take a look into this area. The risk management is actually a very, very important element in trading. Okay, let's check out these statements, which you may actually seen this before in probably some of your encounters, when opening of account and something like that. All right, so which is, or even in the slide, in the disclaimer of the slide, is the past performance is not necessarily indicative of futures trading results. And the second is futures trading represents speculative investment and involve a high degree of risk. And an investor should, could lose all the or substantial portion of his and her investment. So this looks so risky in terms of trading futures. Are they really that risky? Is that is the nature of trading futures? Let's find out, because in reality this is just a very good disclaimer. But whether or not the risk is actually not really on the instrument, but it rather could be something on your the way you handle, the way you trade. All right. So let's discuss trading and risk. So first, you recognize trading involves risk. So this is a very important thing, because as long as you recognize the risk and you will do something to control it or contain it. And second, trading is a risk your equity on a trade. So whenever you go trading, I would say I go risk my money on something, whether I do a long call, a short call, when I'm doing a bull spread strategy or bear spread strategy. So it's all about risk. So you'll never say that I think the market going up, so that's why I buy or I long. So you are actually predicting the market maybe going up or down. But in reality, it's difficult for someone to predict the market. So it's more like you're risking your money into, say for example, a trade. Okay, and futures trading has risk, but it has the risk just like any other trading instrument. So it doesn't say that trading future has got more risk than other instruments. So in fact, if you know the way I trade, I would say trading futures might have slightly lower risk than other instrument. So it all depends on how you look at it. And lastly is knowing and understanding the risk is key to successful trading. And this is really I mean it. And yeah, so please bear in mind, this is the most important thing that you need to know and understand and practice it before you can really make it to become a trading for a living kind of thing. And first thing first, you have to understand futures contract. Futures contract is actually you're trading a contract, so that's why we call futures trading, because the futures trading is actually a futures contract. You're doing a contract, but the good thing is the contract you don't have to keep on signing forms and all this, because now everything's electronic, so you can just do it on your screen. And futures contract has expiration date, so this is very important as well, because this is a risk factor. Expiration carries quite a number of risks. Actually, a lot of risk also starts from the expiration date. And futures contract has got a settlement method. So usually, whether it's physical delivery or it's cash settled. So what is physical delivery? Usually like commodity like palm oil, which is our star product in Malaysia, bean oil, which is the competing oil. These are the commodity or futures contract. If you buy a palm oil contract and it was expired or you matured, okay, you are bound to actually take the delivery at the port. That means you will take the oil and become yours, right? You have to pay the fee, of course, full fee. And this is something that you don't want to do, because this could be risky, because you have to pay quite a big sum of money to take the delivery. Now, second type of settlement is cash settle. Cash settle is easy. Cash settle, that means there are some instruments in Malaysia, for example, gold contract, the financial index FKI. So they will actually settle with cash, means if you lose money, then they will deduct from your account. If you make money, they will actually credit the profit to your account. So it's quite easy. Now, when you start to think of risk management, first thing first, risk control, I believe that is the center of every successful trading story. You will heard or read a lot of books, stories about how successful or how not successful a trader is. So to be successful trader, so risk management is the key element which which determine whether you are successful or not successful in your trading. So second will be controlling the risk exposed in every trade. So this is also equally important, because if you cannot contain or control the risk, because trading involves risk. I mean, even you do any type of business, there will be risk involved. Driving a car, you will have risk. Open up a F&B restaurant or cafe, you have risk, So, but the risks also usually associated with chance of have some profits. So understand that every single time you're going to any single trade, there will be some risk. So don't say that I kind of cannot take if you say the market is very low, so it's low risk to go in now. So actually that is not so true. So every time you go in, there will be some risk. And third is trade with money that you afford to lose. Of course, it sounds so pessimistic, but that is true, because if you needed the money tomorrow to pay rental, buy food, you won't be easy for you to carry a contract that you maybe lose money. So that is one key element as well. Now, if futures trading is that risky, so understanding this will help you to sort of not be so scared about trading, and you start to have confidence in terms of trading. So is it risky? Let's put it this way. Now, if you're trading a stock or equities, or you're buying something that which you have a tangible asset, okay, something to hold on, so you pay full asset value. That means if you buy something, then you pay up the price. So what it means is that, let's say if a stock that price at 89 cents, okay, if you buy 100,000 shares of this particular stock, so what you need to do is you pay 89,000 ringgit, right? This is the money you put on the table to acquire this stock and declare this is your stock. Okay, if the stock appreciate, you make money. If the stock depreciate, you lose money. And something you're very sure is that you wouldn't lose all the money, or the maximum money that you can lose is 89,000, because you wouldn't lose more money than you deposit in, right? So if the company wind up, so you will lose all the investment. So your risk is actually max at 89,000. Now, then when you start think of trading futures is you trading with sort of method called margin. Margin is leverage. That means you don't have to come up with the total value of the underlying asset. For example, FKI is actually, let's say the time that when I do this slide is stood at 1,780. So every single points of FKI is 50 ringgit in terms of the contract value. Then you multiply the 50 ringgit to 1,780, you get 89,000 as well. I just want to put up the number to be exactly the same. Now, how much money you acquire to sort of control this 89,000 contract? Let's say I put margin 4,000, which is few months ago. Last month Bursa has reduced the margin to 3,000 only, but this is actually based on 4,000. The formula, it will be the same. Okay, so what you get is actually you are using 4,000 or rather 3,000 now to control the asset of 89,000, assuming the index is at 1,780. So by doing so if FKI go against you by 80 ticks or 80 points, you could actually have the 4,000 wipe up, because 4,000 is equivalent to 80 ticks. So then you will say, oh, I will lose all the money, even it just dropped 80 points, right? So it probably dropped 2-3%, so I lost all the money. So is that makes this instrument more risky? Not necessarily. So imagine this is how you trade. Let's say, for example, just give you an idea, so that, of course, I'm not saying that this is the way that you should trade, but give you an idea. So FKI theoretically should never go zero. This is assuming that, because FKI is actually comprises of 30 top counters by capital. So those are the blue chip stocks which we usually refer to. And these blue chip stocks, we are assuming that they'll always be there, because any counter that drop, I mean, because of their losing money, the counter, it will be replaced by another counter. So the top 30 will always be in the FKI. So assuming FKI now stood at 1,800, okay, the value is 90,000, right? Now, if you use 9,000 as your capital, or you pay the full value of this contract instead of you paying 4,000, or even half of it, 45,000 to control one FKI contract. Now, assuming if this contract will never lose, become zero, so you need to lose 1,008 or 900 points to wipe the margin of your account. That means you can always control this as long as you're not losing 1,800 points. If you're using 45,000, that means 900 points. Will FKI lose more than 900 points? I don't know, but chances are not there. Chances are very slim. But let's say it actually becomes zero. So I don't think so, because as the valuation calculated by this index, it couldn't go that low. But never say never. But assuming this, the downside risk is actually slightly smaller in terms of if you're using a full margin or full contract value to trade. Now, so that means that the futures trading become low risk, not necessary, but it just carry the same risk as you're trading any other stocks, as long as you actually using substantial enough margin to withstand any whipsaw in the market. So that is how I define risk. If you understand this, then you start to develop a method how you can approach this market. And future trading is not as risky if you have adequate margin to withstand any whipsaw in the market, but that is actually means that you're not over trading. So it comes to a conclusion that as long as you are not over trading, you are okay. So if one uses high margin leverage to trade securities or stocks, the investment can be as risky as futures. So that means you're using margin account to trade stocks, which you borrow money, to trade the stock that the value is actually much higher than you are actually putting in the money. Let's say, for example, you put 100,000, but you're trading 1 million shares. So those are carry 10 times risk, just like you're trading futures. So if you understand this, so then you will have no problem taking risk in trading futures, because once most of the traders, the path is you start trading stocks, you start trading FKI, you start trading FCPO. So these are the conventional path. And if you're okay trading stocks, so actually, if you understand this concept, you can trade futures at any given time already. So a futures contract, you have to understand a few basic things. Okay, it has spot month, means it's the last month before it's expired or matured. Remember, the futures contract has got expiration date. So normally the expiration date explain when or which month this contract go into spot. And usually these are spot month that we don't trade, especially those with delivery. So unless they are cash settle, otherwise usually we don't trade. Liquidity, not every contract has got people trading, because some contract has got substantially lower volume compared to other contracts. So you have to be aware of that. So this future contract also has got a margin requirement. So you have to read all this before you start trading. Okay, with that, okay, what is spot month? Spot month is actually the current and the last trading month before a futures contract expires. So some contract active in the spot month, let's say, for example, those trading with cash settlement. So usually there will be the contract that there will sort of be active in the spot month. So FKI is one of it. So most traders are trading FKI in the spot month, especially even the last few days before the contract expires. Usually FKI are most active during that period of time. Why? Because the nature of trading financial index is like that, because it's cash settle first thing first. Second is because there will be a lot of rollover contracts for this period of time, which the liquidity will be increased, and that's the time that, you know, as a trader, there will be some opportunity that which you can capture, you know, any chance of making some money. So some contract active in the spot month, which I just mentioned, FQI, and also the FGLD. So FGLD is a contract that, because it is a so-called contract that, you know, carries a value to their underlying assets. So the spot month is actually has got the highest correlationship to the physical market or the underlying asset of this instrument. So lastly, some contracts is only active for the third month, which usually they carries physical deliveries. What is physical deliveries? Like the gold contract is actually not physical delivery because it's cash settled. It will be mentioned in the contract specification, which they mention whether it's cash settled or physical delivery. And whenever there's physical delivery, there will be a specification for the goods as well. So this kind of physical delivery contract, usually as a traders, we will avoid this delivery because we are not really the one that take delivery, but there are some hedgers, some manufacturer, they really take this delivery. So those people will be the one who go into spot month. And the contract that takes physical delivery is CPO, or in our terms FCPO. COMEX Gold is also physical commodity, so you will usually try to avoid the spot month. So what you do is actually you only trade the third month and onwards. So that is why and how you try to avoid trading this contract. Now delivery is futures contract, that usually buying a delivery option. So physical delivery of commodity metal, so in CPO or FCPO rather, is crude palm oil, CPO. COMEX Gold is actually the actual gold 1 troy ounce. And again, FKI, FGLD is cash settled. Usually, most of the traders start trading these two instruments before they really, get used to the pressure of physical delivery. Because as I'm trading palm oil a lot, I'll be trying to offload my contracts before it go to spot month. For example, September will be going to spot month on the 15th next week, okay, noon. So I'll try to clear all my September. In fact, I cleared all my September yesterday. So yeah, you try to clear as time goes by and before spot. Because physical delivery really, like, you need to have an oil tanker, go to the port. If you buy, then you have to pump the oil from the tanker to your tanker, and so forth and so forth. So you don't want to do that. So but cash settle is easy. Cash settle is just you look at your statements. If you hold the contract until the last day expiration of this commodity or contracts, okay, there will be settlement price. So once your settlement price, so your price will be settled there. So if the market close, let's say 5 points higher than where you buy, then you make 5 points. So if the market close 3 points lower than where you buy, then you lose 3 points. Is automatically in the last statement on the last day of the contract expire. So it will be deducted or credited to your account. So cash settle will be very, very easy. Now liquidity. So due to traders usually focus on the active and benchmark contract month, usually the liquidity is lesser for non-benchmark contract. So for example, if you're trading FKI, you're trading the spot month. If you're trading CPO, you're trading the third month. The third month is always start from the 15th for CPO. So now the third month is actually still on October. That's why it's active. And after next week, it will be November as a third month. So then November become more and more active. But then if you take a look at the contract, you will notice that actually not only the third month is active. There are other months like second month, the fourth month, fifth month, sixth month, now up to 12th month. They are all active. Why these are active? Because a lot of traders are trading different contracts to to make up strategies. This we have been shared in other webinar in this series, which we call spread trading. So which many traders are trading different contract with spread strategy as well. And most of the trades of the non-benchmark contract, because it's trading by hedges, because if you have contract to hedge in November, then you start trading in November. And you can see that even January 2020, March 2020, there are some open interest already. And also the spread traders are some of the popular method where we trade up to 12 months of contracts. That means we trade from September now until September next year. So yeah, this is how another strategy of trading is we are doing it in the market. Now, lastly, some futures contract is physical driven, so like CPO. So traders will avoid the spot month. So because we don't want to be forced to deliver or accept delivery, so that's why the spot month usually not many traders are doing. I've been asked whether can I take, or trade the spot month. Yes, you can trade. There are some traders actually trading spot month, but there's some requirement, the margin requirement, you'll be subject to tender and all this. So the risk is actually too high for any basic trader or retailer. So I'll advise to avoid this as much as possible, unless you know what to do, because it's all about risk. If you know the risk and you know how to contain the risk, I know there are people like to trade spot month and they make quite a lot of money because of contract go to spot. Now, before that, you also need to know about margin requirement. This is also very important because it's here. Margin is set by exchange. It's actually they calculate based on the volatility, the risk, and all this lah. So usually a small cash margin is required to control one futures contract, right? So and usually it's around 5 to 10% of contract value. So take a look at the latest notice on last month on the margin required. So you can see that CPO over here has been reduced. Let me get the pen, to 3,000 from 4,000 per contract. Okay, this is a very good, encouraging, because that means the margin required to hold one contract is actually lower. So hence your leverage become higher, but also it means the risk of trading this has been reduced a bit. But at the same time, if you over leverage, that means you actually, let's say for example, usually you're trading 3 lots, but suddenly because of this you're trading 5 lots. So that means your risk is also increased if you're actually wrong. So you have to be careful on that. And you also see that there will be some other contracts. Okay, you can see that this is an intra-tier spread margin. So that means the first tier 780, second tier there will be 360. So this is the new tier system which we just implemented, and this is a very good way. You see, trading spread, you have a much lower margin. That means you're trading one contract, you have to pay 3,000, but you're trading a pair of contracts. That means 2 contracts, you're paying 780. So it's actually different way of trading, but it is not in today's topic. So we jump on another page. Okay, here you can see that we also have MG. This is the government bond, but let's say we focus on the futures contract of gold. Gold is 800 per lot. I think the margin remained the same from last month. There is another thing that just decrease is the margin requirement for FKI. It's also 3,000 now, and the spread is only 450. So you see the margin requirement is actually adjusted, okay, based on the risk, based on the volatility. So now, why I say it could be risky? Let's say, for example, you're holding some contracts, okay, and the margin is 3,000. So you're happy because let's say half the margin of your account is utilized on the margin, but suddenly they increase to 5,000. That means suddenly the jump of 60% increase. Okay, so your margin become probably 75, 80% utilized in your account. So you will have some pressure when you're not making money or the person against you. So suddenly you realize that you need to cut loss, because we have experienced sometimes due to margin increase. So some traders have to cut loss because they have to reduce the position to avoid margin call. So the margin is actually another thing that you look at. So we have calculated. Okay, now we go to one topic that you may need to bear in mind is what is the leverage. So from leverage, usually I can roughly know how risky a contract will be is. For example, CPU price is at 2,700. I just pick a number first, and the contract size is 25 metric ton. So that's why every single contract you're binding, because it's 25 contracts. So 2,700 in terms of CPU price, you are binding with 25 contracts ton. So that's why you times 25. That's why one tick is 25 ringgit actually, because of 25 tons is actually buying the one contract. So your contract value is 67,500. So FKI, same thing, you calculated, you get 85,000. This is how you get things running. Now, how to calculate leverage? It's quite simple. Just put the contract value over the margin required. Let's say if 85,000 is the FKI contract value, over the margin required, I use the 4,000 first because I'll give you a few examples. Okay, then your FKI leverage can be 21.25 times. Okay, 21 times is actually quite some substantial risk involved when you're trading that. Now, if I reduce the margin, okay, for the same contract value or slightly lower contract value, 1,750 or 82,000, okay, even a lower margin at 3,000, okay, you're still talking about 27 times leverage in this trading. So another example, leverage 3. So this time we use CPO. The contract value is 67,500 over, let's say, 5,000 as margin. Your leverage is 13.5 times. Okay, so the risk somehow reduced. You see, even the contract value, the margin can be more or less the same, but the risk, may not be what you're thinking. The risk can be representing with the leverage. Now, for example, if I take an example, recently we stood about 2,100, let's say. So over the contract of 52,500, if the margin stood at 3,000 as of now, the risk actually increased from leverage, from 13 to 17.5 times. So this is the risk. The higher the leverage, the higher the risk. So how to reduce the leverage? That is something that you can do. You see, you cannot control the risk of the market. You cannot control the market go up or down, but you can control yourself. So how to contain the risk? Just give you a very, very simple example is, okay, instead of you go in CPU contract with, let's say, 3,000 one lot, right? So you're trading, you put in 5,000 or 3,000, you trade one lot, which is, 17.5 times your risk if the market go against you. But what if you put in 6,000 rather than 3? So your risk actually of the leverage type of risk is actually half. So you talk about something like 9 times only. So if you put in, let's say, 9,000 to trade one CPU, so your risk become even smaller. So this is one of the angle that you can take a look to refine your trading strategy to reduce the leverage risk. So leverage is just one of the risks we are talking about. There are more, okay, so which we will start to focus on 4 major topics. First is risk per trade, then risk and reward ratio, winning ratio, and number of trades. There are many, even others area, but we focus on these 4. And I believe if you get these 4 rights, at least you have a very, very good head start. Now, for example, in trading, it's important to know that how much one can risk in every single trade. So usually the conventional wisdom is 1% of your equity. That means if you have 100,000, you don't lose more than 1,000 of your equity in every single trade. It means every single trade you lose 1,000, you try to stop loss and get out from the losing trade, which means try not to lose more than 1% from your account. Okay, this is like, let's say if you have a lot of marbles, okay, if you lose one marbles, if you have 100, out of 100 you lose one, you feel okay, right? Even though you lose another one in the next trade, another one in the next trade, so you are losing, let's say 5 consecutively, which you lose 5 marbles from your pack of 100 marbles. Do you feel sad? Not necessarily. But if you have only, say, 10 marbles and you lost 5 marbles, so you lost 50% of your equity, you feel sad and you feel depressed, you start to be panic, your trading become erratic and become very unstable. This is how sometimes one cannot trade well. But of course, controlling your risk, let's say not to lose more than 1 marbles, it's also, that means every time you make lesser, because you'll be controlling your risk in this case. Now, then this is first thing. That means try not to lose more than 1%. Okay, and second is actually risk to reward ratio. This is a very debatable topic. Okay, it is expected returns or reward of the trade to be amount of risk taking to capture it. That means how many R or risk that you're willing to risk in order to capture, how many times of the risk that you put up on the table. So commonly it's advisable to at least a ratio of 1 to 2, meaning you're risking 1 ringgit to potentially make $2 or 2 ringgit, which is a good bet. And usually it's where and how you put your stop loss order and stop profit order. For example, you long FKI at 1750. Okay, your profit target, because you can see that let's say the resistance or the previous high is at 1760. So your profitable target is actually 60 or 10 points over there, and your stop loss is 45. Okay, 5 points away from your entry. The reason is because that is the previous support, or there is an EMA there, or some other indicator that tell you that is a support level. So that's how you calculate. The risk is 1 or 5 points to 10 points, and so hence your risk and reward is 1 to 2 or 2 to 1, and that's how you calculate. So it looks like it's actually working. But just to share with you that, yeah, you also have to understand that this risk and reward thing is actually virtual. That means no one knows for sure whether 45 will be supported, whether 60 will be resisted. So it's all imaginary, it's all virtual. It can be, the risk can be much more than 45 that you predicted, and your reward can be much more than you predicted. So for example, if you say, the downside risk is actually minimum, blah blah blah, so but not necessarily that is the case, because the risk can be bigger than the reward, because actually no one knows. But if you execute the cut loss at 45, that means 5 ticks you take, or 5 points you take a loss, or cut a loss, your loss is actually limited, so you don't see any more downside risk. So that's why you said the downside is limited, because based on your analysis. So that's why the execution of whether limiting the risk or cutting losses is equally important in this area, in order to contain the risk, whether you lose money or not. But having said that, I just don't want anyone or trading, they are using this method to measure the risk. So in my actual trading, I will be say that sometimes, in fact, most of the time, the risk is much bigger than you thought. But after a series of winning trades, you tend to forget your risk is actually, to put it in a very sarcastic or irony way, is usually you calculate your risk to reward is 1 to 2, but your actual risk can be unlimited risk at all actually, but your upside can be unlimited. Okay, so what is unlimited? Unlimited can be your account becomes zero, so it's infinity, so you lost everything. So always bear in mind, going to trade, you always have the chance of hitting the unlimited risk. There's always a black swan, there always something might happen. The strategy I'm trading is, as I always say, that I cannot control when the market will be go against me. That is something I cannot control, but I can control number of lots that I buy, when I take profit, when I cut losses. So once I control this, so my downside risk is actually contended by myself. So it is not to say that if your analysis is good and then you have 1 to 2, 1 to 3 kind of return, okay, then your downside risk is minimum, then you should go all in into this kind of trade. That's not the case. Okay, maybe another way to know that actually you don't know the future. You predict 1 to 2, but it can be 100 risk to 1 reward. This could be true. This happened to me sometimes. Like I may have a 16 risk, 1 reward. So how I know? Because after everything has over, then I know. Okay, now a better measurement of risk to reward is the way you trade, rather than you predict by using the strategy that I'm saying, that where is the resistance, where is the support, then you get a 1 to 2. Now probably I will give you an example how you can get something similar, but they are fact. Okay, try to, let's say, use month by month. Okay, how much of your profit divided by how much if you lose. Let's say if you make 100 ringgit, then you lost 50 ringgit. So 100 divided by 50, you get 2. This is a profit ratio. So in a way, sometimes this is representing your risk and reward ratio, but they are not projecting. They are something that happened, and you can trace back in your statements or your records or your journal. That's how much you make and how much you lost, in terms of trades or money, okay, in your account. So if you divide it by the profit to your loss, you get a profit ratio. So if you have a profit ratio of 1, is actually not much. Okay, if you have profit ratio of 2 or even above 2, 3, 4, 5, I've seen profitable that more than 10, 20, hundreds. So if you have that, then you can say that you have very good risk to reward ratio, which your calculation of the risk and reward ratio is matching your actual risk and reward. So this is a good probably way to test your trading. So I recommend go ahead and do it. You can't be successful trader overnight, but make use of your experience. So experience is not past. Try to use your previous records to calculate your expectancy, to calculate the simplest one would be profitable ratio. So then get you to where you wanted. If you have something that positive, probably 2 to 1, profitable ratio is actually 2 and above. You're in safe place. Your direction is actually correct already. Now, okay, that's why I said that the risk control, the risk management side is crucial. It is utmost important element in trading. If you get it right, you're there already. You know that you're there already. Now, thirdly is winning ratio. How many times one win over losing trades? Okay, usually we talk about it in percent. And okay, I have calculated at least you need 65%. Of course, some people say because of positive expectancy, even 30% is actually good enough, as long as you have so-called positive expectancy. But please bear in mind the number of trades which we're going to discuss also very important. So if you sample enough trades, then you'll realize that you need a higher number so that you have the confidence. Let's say, for example, if I'm telling you, I'm as the trader, according to my past 100,000 trades, okay, my winning ratio is 75%. So then I'm asking you a question. Do you think that the next trade or the next 2 years I'm trading, can I make money? Usually can. So you have the confidence to go in the market when nobody has. So because you have that kind of winning ratio before. So winning ratio is crucial. Not only to make money, because of course expectancy is much more better, but if you have a high winning ratio, means you have the confidence in trading in any market. So to me, do some homework, dig out your last 100 trades, calculate how many percent you're winning trade. If you have 65% and above, then your system is actually looking pretty good, and you have the potential to be successfully in trading for a living. Or most important, to get 85%. If you come up with a system that 85% is very, very good, and you should follow it 100%. Of course, it's almost impossible, but it's actually possible also if you really do everything right. Okay. Now, the last one is number of trades. Okay. Now, a lot of people will sort of like, underestimate the number of trades, the importance of number of trades. You can have something that you build, you backtest, the system looks very, very well, extremely well. You have high percent of winning ratios, but then a good system should have a realistic number of trades. That means it should go through some number of trades before you call it a good system, a good way of trading, or the rules or method that you want to call it. An over-optimized system only have a small number of trades, although it has a very high accuracy, can be like 100%, which only works for a certain time frame, because usually over-optimized system, when you put real money into tasks, it cannot last. Usually you end up not making money, if not losing money. So if only have one entry and exit in 1 month or 1 year, usually I will say this is over-optimized system, which you shouldn't continue using it actually after you backtest it. So you will not only have enough trades to achieve the desired returns, but you also, put yourself into a curve fitting kind of scenario, which your system is bound to fail over time, because one is bound to have wrong trades over time, because there's no way you have 100% accuracy in your trading. The most you get 99.9, which is very rare. Even you have get that, so you still have chance to lose some trades. So number of trades is important. So so one day when you think that, every time if EMA cross this, cross that, then I'll do buy and sell, blah 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 blah. Think of this: how many times you have gone through this kind of scenario? 1, 2, 3, 4, 5 times? Is that enough? If you ask me, no, because the way I'm trading, I have been trading this type of method thousands of times. Okay, so I don't know how many thousands. Okay, so probably tens of thousands or 100,000 times. So, and it still don't give me a confidence that I will go all into every single trade. I'll still go in as in the first time I trade. I'll be very cautious. I'll be very contented. I'll be carefully construct and slowly executing my trade. So trading is that, you can't be too careful in trading. Now, almost towards the end of our seminar today, but there's a few more slides I want to share. Is sometimes it's more important to be able to manage losing position. So this is part of the risk management side, but risk management is more like when you talk about money management, which how you start or how you stop, how you execute, how you do a position sizing. So do search on position sizing. Position sizing is one of the topic on risk management, but the topic is actually quite big, but it's so easy to just put a simple formula. Let's say, for example, if you have 100,000, you want trades, okay? Don't put in 100,000 in one trade. So you can put in like 1,000 or even 10,000 in one trade. So you put your U size to be, let's say, 10,000 each time. So 1/10 or 10% of your margin or 5% of a margin. So use a small size in terms of trading, then your risk is actually substantially reduced. Now, how to manage a losing position is, when we trade, winning position is quite straightforward. Just take profit. There's nothing to think about. So usually my winning trades, I'll just say I'm just lucky. I just buy here. The next two ticks, 4 ticks, I take profit. So it's nothing to be shy about. So just get lucky for the day. But a successful trading is how you manage a losing position. That means when you lose money, how you want to do it. So minimizing losing position will also improve your winning ratio. So why I said it? Let's say, for example, if everybody go into trade, you have 50% chance. If you do not trade, then yeah, any single trade is actually 50-50. So you have 50% chance of winning, you have 50% chance of losing, right? So if the 50% of 5 trades you make money, you just take profit. The 5 trades you're losing, okay, if you can reduce the losing trade of 5 or 50%, that 30% or 3 trades, you try to reduce the losses, or you actually contain or minimizing the risk, and you do some hedging, then you're not losing anymore. So that means that 3 trades become maybe make a bit of money. So how many percent is your winning ratio? It's 50 plus 30 is 80%. So having said that, if you have a managed losing position kind of method, you actually able to sort of increase your winning ratio substantially. You see, you just need to manage 30% of 60% rather of your losing trades. Okay, that 30% of your trades, if you manage and convert the losing trade to a winning one, okay, then you instantly you get a 80% winning ratio kind of trading strategy, and that is made possible. And one of the important strategy that this can be done is doing a spread trading. So when you try to do spread trading, there's so many ways you can contain and make your losing position to making money trades. So that's how sometimes we improve our win ratio compared to other traders. Now with this few more slides, let's go on to it. Is you also have to be careful about mark to market. This is part of your risk management. If you just, it's a measure of the P&L that can change over time because you're holding a lot of position. Sometimes the position can mark wrong in your favor or against you. Any open position has a floating P&L, and the exchange or broker will use the mark to market to execute margin call. So margin call is nothing to shame about, but try to avoid this. So if possible, you spare quite a lot of margins not to allow the broker or the exchange to margin call your account. So maintaining a sufficient amount of margin in the account is important. It's so easy to do it. So, and you can do it. You cannot you cannot argue, or you cannot control the market to not allow you the margin call, but you can actually put more money, or you trade lesser or smaller size in your trading to avoid margin call. So this is one of the way well, you can control your risk as well. And margin calculations. So let's say margin usually is 5 to 10%, right? So using this CPO 7,000 divided by 5,000, for example, I take a higher value. So the margin is actually 7.4%, which usually from 5 to 10%. This is the range. But the exchange can increase and decrease the margin according to the market volatility. So in other words, if the market is volatile, the margin could be increased, or there's long holidays, the margin also can increase. So make sure you always have in mind the margin can go up to 10 or 15% of the contract value. So don't always assume the market is always at low. Let's say 5% only the margin required. The margin can go up to 10, 15. So always have a buffer in your account that encounter this kind of scenario that potentially could make your account margin call. So avoiding this kind of thing is, as I said, this is something that you can do it. You can control it. So once you control or contain all this kind of risk factor in your trading becomes quite a minimum risk. Okay, not no risk, but at least minimum risk. Now, last but not least, okay, I would like to probably throw you a ball, call signal or risk control. So in my take or my opinion, trading signals, or many people has been spending times on whether EMA is better than Bollinger Band, whether stochastic is better than RSI. But do you know that the signal is only comprises maximum 20%, 30% of your successful trade? Okay, it can be lower, it can be 10% only, you know, in a successful traders kind of method in trading. But the risk control or the money management or money risk management is 70-80% of a successful trade. This is my opinion. Now, so don't succumb to hunt for a perfect signal. There won't be any perfect signal. I have been doing back tests for a couple of years. I have tested a lot of ideas. I also encounter how one traders can be misled by a lot of signals that they interpreted from the system. So my opinion, or probably my advice, is do not succumb to hunt for any perfect signal. That's assuming perfect signal don't exist. So how to be a successful trader is you have to do risk management in your trading, rather than you need a very good system. Of course, I do back tests, but the way I look at back tests is different to look for perfect signal. I want to look for something that how this can be done, but how I can do it better with risk management. So last, I want to emphasize again is focus on the risk management if you want to successful in your trading. So with that, probably I go to my last segment of tonight. So I'll hand over to Chun Sang for the Q&A session.
Hi, thank you so much, CC, for your wonderful sharing on how, as a trader, we can do risk management when we trade futures. Now, if you have any questions to ask our speaker today, please write in the question box. We will go to your questions shortly. While you are writing on your question box, let us launch a poll. Okay. Now, which is more important to you? Select one of the following. Is it winning probability more important to you, or risk to reward ratio more important to you? Let us know what you think is more important to you. In the meantime, if you have any questions, please write in the question box. Alright, giving you extra 30 seconds. Okay, let's close the poll now. Okay, let me share the result with you. Here is the result. 30% of you pick winning probability is more important to you, while 70% of you pick risk to reward ratio more important to you.
That's good.
Well, CC, what would you pick?
Yeah, I'll pick risk management.
Risk to reward,
yeah,
risk reward ratio, is it?
yeah.
Okay.
Uh,
Okay, great. Okay, now let me go to the list of the questions that I have on my screen right now. For the first question is while the level of risk is very much an individual preference, what would be a good rule of thumb for a risk reward ratio?
Okay. As I just said just now, risk and reward is really something virtual, something that you have to imagine yourself. Okay, if you pick 1 to 1, probably you think it's laughable. 1 to 2 is basic, and many has recommended like 1 to 3. That means risk 1, then 3R 2R. In reality, is you're picking something that high winning reward ratio. Okay, that means you go for a trend. You go for trend trading. Trend trading has got a problem. If you catch a correct trend, you make quite big. If you catch a incorrect trend, you cut loss. And if you are those type that really executing your risk and reward 1 to 3, 1 to 4, you always cut loss, cut loss, cut loss. So how many times you cut loss before you lose confidence? 5 times, 10 times. So the risk reward is really something that it become crucial when you pick the type of trading you are. If you're a trend trader, your risk and reward can be 1 to 2, 1 to 3, okay, at least, okay, so that to make it, at least you make money in long run. But then 1 to 3 is actually for trend trading. Uh, it's not easy. Let's say, for example, if you want to make 200 ticks in CPO, 200 points in CPO, if it's 1 to 2, that means you are asking for risking of 100 ticks. Will you accept you lose 100 ticks before you cut loss? No, right? Probably no. So having said that, if you want to make 200 points, but you're not willing to take 100 points risk, so your risk and reward, most of the traders will say, okay, 1 to 2, 1 to 3, 1 to 5, but likely you are actually asking the market giving you 1 to 100. That means you want to cut loss in 1 tick, but you want to make 50 ticks in a day trade. So your risk to reward definitely is actually 1 to 50. If you have a 1 to 50 kind of trading and it is true, okay, then you don't go in one lot, you go in 100 lots, right? So you almost have a surefire way of make money. So the actual risk and reward is, if you're picking, I'm not so picky of risk and reward, okay. Let me share to you my take of risk and reward. Conventional 1 to 2 plus, that means you can be have 2 to 3, should be okay. But most people do it wrong, because you want to lose 1 tick but you make 50, so you got it wrong. That so if it's 1 to 2, means you cut loss at 25 ticks but you take profit 50. Okay, so which, if you really imagine, this is something unimaginable. Most people won't take it. But if you ask me, the way I trade, please don't laugh lah. My risk and reward can be 1 to 1. Okay, so that means I'm willing to risk 1 tick to just make 1 tick, or I willing to risk 2 ticks to make 2 ticks, or I'm willing to, sometimes I may be potentially making 4 ticks, but also have potential losing 4 ticks. So you could be looking at, I am actually losing 1 to 1, okay, which is as I said, is a laughable kind of strategy. And the worst is what happened to me. Let's say, for example, yesterday I have a trade, okay, my risk to reward is, don't laugh, 2 to 1. I'm risking 2 to get 1 reward. You see, I'm trying to make 2 points profit. Ended up I cut at 4. All right, so my risk and reward actual result will be 2 to 1 already, which is totally out of what conventionally people think it might be for full-time trader. Yeah, so conventionally, I think 1 to 2 is, to me, best already. Something that you could have hoped for. But in actual trading, I could be looking at 2 to 1 in reverse. In fact, in my heart, I will be looking at my risk can be unlimited. Then my gain is only 1. That means you can be looking at actual risk is unlimited risk. Your reward is always 1. So this is the way I think. If you're asking me my opinion, risk is infinity. Your reward is always 1. For example, today we bank on the market can be correction because CPU has been went up for quite a while. We bank on corrections. Instead, exactly today at 4 p.m. Everything go up, so suddenly things shoot up. So yeah, we always has got the risk, but also we took the risk. I sell a contract, let's say for example, but towards the closing, the market corrected back. So I make the 2 ticks profit lah. So I'm looking at 4 ticks risk to get the 2 ticks profit. So yeah, actual fact is not beautiful lah. So 1 to 2 conventionally, I think is good enough already, but in actual, what you get is probably 2 to 1. All right. I probably answered too long for this question.
Yeah, but you need to have a high winning ratio, high winning probability to ensure that this kind of strategy, 2 to 1 strategy,
exactly.
can go long term.
I almost forgot. Thanks, Chen, for reminding. So that's why for example, my type of trading is I go for high winning ratio because my strategy allow me to repair my losing so that I have a higher winning ratio over this strategy. Yes. Yeah. This is crucial.
Yeah, so when you have high winning ratio, then you will feel more confident.
That's
All
right.
Let's look at the next question on my screen. Is the risk management strategy similar in warrants trading? Because both warrants and futures have an expiration date.
Yes, they are essentially same. The only thing is you have to when you talk about warrant, there's a lot of warrant in Malaysia. There's call warrant, put warrant. There are also the conventional warrants for a company. Especially if you talk about call warrant, then it's very similar. But there is one catch, okay? Because if you're buying a warrant, your commission, your brokerage is actually calculated based on percent. That means how much the value of the transaction. But futures transaction cost is actually fixed. That means no matter how many lots or how high the value of this commodity is, okay, the brokerage you pay is the same. So the cost is actually different. First thing first. Second is a lot of call warrants is calculated based on the value of the underlying asset plus premium. Okay, that means every time you go in, you pay the premium price of the underlying asset. That means the asset can be worth 2,000, but you're probably paying 3,000 to acquire the call warrant. Okay, so the cost of the premium is actually costing everybody. So everybody have to, or somebody have to bear the cost of this. Okay, but futures, it doesn't have the premium because you're trading the actual instrument. The actual price of this commodity reflecting anything happens in the world that affecting the price. So you're trading the actual price of this commodity. Any price actually not actual or not fair to this commodity, it becomes mispricing. Usually you make money. So that is the difference. So I would say if you're trading call warrant, you have to be extra cautious. The risk is actually slightly different in terms of you paying extra cost premium. The expiration date of, let's say, certain warrants is probably too long. So the risk is actually, my reckoning is that it's slightly higher because futures risk has got this. Futures has got expiration date, but they have the continuous contract. Let's say if October or August going to expire, you have September to take over. When September expiring, then you have October to take over and November and so on and so forth. So you can postpone, you can push your losses actually to the next month. So it makes the risk management become, you can continue the life of a losing position to next month and next month. But a call warrant, a conventional warrant, once it's expired and expiring, they become almost worthless if it's not in your money. Then you do not have time to extend unless the company apply for extension. Then you have time to extend. But in futures contract, no, you want to extend, just roll to the next month. So you have the continuous of so-called time extension. The time decal is there for you to roll your contract. So I would say it's as important risk management in call warrant and futures, but I think the call warrant side, you need to extra have time decay as a risk to control or contend it.
Okay, now there's a follow-up questions on the transaction cost for the futures. How much does one trade cost?
Okay, if you look at nowadays the rate of trading commodities is very competitive. Okay, if you're trading, let's say, very little minimum volume, you can look at like 20 ringgit per contract. But if you start with some experience and you negotiate with your remiser or broker, usually they will offer you some cost, net cost at 12 ringgit plus a bit, like 20-30 cents of SST. Let's say we talk about 12 ringgit or 10 ringgit. Certain requirement, let's say if you produce more volume, there will be much below 10 ringgit. So you talk about, let's say, roughly around 10 ringgit. Retailer probably you can higher volume, probably you talk about 4 ringgit to 10 ringgit. And fixed cost. So no matter the CPU contract is 2,000 or 3,000 or 10,000, you're still paying the same contract cost. Okay, unlike other instruments, sometimes they use percent of the contract value or the stock price, then it's different. But futures contract is by number. And if you trade more volumes, in fact, Bursa Malaysia has got a lot of incentive programs for you if you become volume traders. So which you enjoy much lower commission and also the exchange fees.
Let's say you in one trade you long 100 contracts versus in one trade you long one contract. Is the transaction cost the same?
The consumption, the cost should be the same. So usually your broker has got a threshold. Let's say if you trade more than 30 lots or more than 100 lots, or of course for professional case we talk about more than 1,000, more than 10,000, the cost will be different lah. So yeah, you look at that kind of thing. But conceptually, usually trading 101 lots, your cost is the same cost, means multiply by 100. So if you're paying $10 for one contract, so 100 contracts, so you're paying 1,000 the commission for the particular day. But regardless of the asset value, that means the CI go up or go down doesn't affect your cost at all.
Oh, so it means it's by per contract lah. The transaction cost is
per contract basis,
not per
or per
trade
lot
lah.
basis. Yeah.
Not per
Yes.
trade lah, huh? Okay, so can you tell us what is the market depth? The depth of the market.
Usually when we talk about market depth is how many prices you can see during trading. So during trading, in any conventional market, usually you can futures market, you can see only 5 prices. Let's say if 1,000 is the price, 1,001 you can see how many volumes are parked behind that, and 1,000 the next price 1,002 how many volumes parked selling at the price, and up to 5 prices on the selling side, and then up to 5 prices at the buying side. Currently, Bursa Malaysia doesn't charge you extra for that 5 prices. Do you know that if you're trading in some other country, you can only see 1 price? That means you don't see who is parking.
Price.
Yes, only see 1 price.
That's
So
interesting.
and yeah, and then and certain market in CME in US, you can pay extra money to see 10 prices. So this become unfair lah. Huh? That means there are some people that can see more prices than other by paying extra money. So usually this is what we mean by the market depth, and sometimes we also refer to how many people are parking, because some of the market depth is very shallow because there's no one parked behind. That means if you're buying, let's say 100 lots, only 5 lots is parking there. So once you buy market, 100 lots, the price will skyrocket. You push the price up. But please don't try this in CPO, because there's another market work concurrently with CPO, is we call spread market. Even you see that only total 100 lots are parking in the 5 prices total, but you market 1,000 lots, the price won't go above 5 ticks also, because there is 1,000 lots selling in spread. So that price will come in, and you're actually taking the price. So yeah, sometimes the market depth is also somewhat misleading, because there will be a lot of combination we call price implied, but probably this is out of the scope of today as well.
Okay. Now, just like I mentioned about spread trading, can you tell us more about spread trading? Like, what is spread trading, and how do we trade spread? And is there a minimum amount of model we needed to get started in spread trading?
In fact, we have done so many webinars also with LifeChamp. You can check out in the Facebook. There is recorded in the Facebook as well. Spread trading is actually just like trading the conventional contracts. Let's say you buy October CPO contract, but at the same time you sell November contract. So that way become a spread. Spread must be one up, one down, one buy, one sell, and you do it concurrently or can be separately. And once you do, let's say you long one contract and sell the other month, your contract become a spread, and your broker and the Bursa will recognize this as spread. So your margin, instead of, let's say, 3,000 for buying October, 3,000 for selling November, so your total margin is 6,000, right? No, immediately after market close, your margin becomes 780. So of course, you also can request your broker to recognize you as a spread trader. So your margin, immediately you buy one and sell one, becomes 780. So like us, immediately we go in to this spread contract. There is a special code for spread, which you can do it directly, and you just pay 780. Then it makes that spread trading become cheaper, or it's more affordable to trade. So to my reckoning, is spread trader is actually very suitable for retailers as well. So I started with stocks, FKI, FCPO, and then ended up with trading spread, FKI spread CPO. But I've been conducting some tutorials also to encourage or seminar like with LifeChamp, to encourage traders to, you can actually skip all this and start trading spread. There's no harm, you can trade spread without trading other instrument. In fact, I highly recommend you don't trade other thing and start trading spread, because you get yourself understand the concept of spread better. So there's no minimum so-called capital to start. You can start with as long as you meet the margin requirement.
Okay, thank you, CC. The next question is, can I quit my job today and and do futures trading?
Okay, that will be not so practical. It takes some time, experience to be able to trading for a living. Most people has got different path. Some actually attached to a company. The company happens to be trading futures. They learn up and trading for a living. In my company, there's many examples which they work for me, and now they can actually trading for a living. And also, last time there used to be a local participant, usually we call it, which they are sort of like trading on the floor, which you mingle with all these people. Eventually, you know how to trade. So, can you quit a job and start trading? If you have, let's say, spare some money that you can last for a few years without trouble living, comfortably for a few years, and you still have the capital to trade, then yes, of course. I have some students actually, they quit the job and start trading, but of course you need substantial amount as capital, and also your cost of living you have to prepare to learn. Trading full time is you learn much faster than you're trading part time, but it doesn't mean that trading part time is not practical. So try to work for company that that are actually the business is involved in trading, prop trading, banks, then you learn faster because you get paid, okay, by trading. So by learning trading also. So there are a number of companies also. I know some of my friends are hiring traders. Yeah, you can join this, which is much better. But whether you should stop your job now and start trading tomorrow, usually the path not so easy, not so straightforward. It may not smooth for everybody, but I can always tell you there are some people successful by doing so. I'm sure Shane also know the person that I meant, right?
Oh,
Quit the job and become trader. Yeah, it works.
yeah. Okay, cool. So the advice here is, of course, not to quit your job right now, but to acquire
No.
knowledge, okay, before you
Yeah.
get
That's
into
important.
spread trading. And I think CC Young, you do run spread trading class, right?
Yeah, we do on off do the spread trading class also to pick up traders along the right line and all this. Yeah.
Yeah. So you can
Well,
text CC Young if you want to inquire more about his advanced class on spread trading. So the next question is, do you use auto robots for trading?
I'm still exploring the ideas. I have a backtest engine has uh been running for a while. I write my own coding, I programs, but unfortunately, I do not have an automatic or robot or algorithmic trading. But I'm actually always in discuss with many people, form groups. We discuss. I have some friends involved in writing all the algos and designing testing. Unfortunately, I'm not a robot trading firm. Most of my trades are I'm just manual trading, but I did involve in some research, but I'm not very good knowledge on it. I know so many people are actually researching it, and we know that the insignificant, I mean, in capability of some of the robots, it's just not that AI machine learning is it's not that powerful yet that they can actually think of something and straight away replace human traders. Especially myself, I haven't find the formulas how this can be done. But nowadays, the technology or the software, the company, the platform, the broker, they have a lot of systems that can help you. Or let's say, for example, there is a software that you can park order. Once your order fails, immediately park stop order for you or immediately park your profit exit for you. So this is great because when you do scalping intraday day trading, so you want the order fill, then immediately it will park the stop and the profit exit for you. So which this is totally available. And there's also software called Auto Spreader, which if I want to build a spread, I can just key in the number that I wanted to. The auto spread trader will get the price and get a spread for me. So this is probably we call semi fintech kind of trading, but definitely not robot.
Okay. The next question I have on my screen is, what is the qualification to be employed as a trader?
Okay, as far as I know, there's some requirement. Some do require you to have a degree in some related field, either IT, programming, economy, financial. But there are some also there's no requirement as long as you pay a small fee to sort of like cover the risk. And also there are some tests usually. If you join a prop firm, either knowing the prop owner, the prop owner will ask you some question whether you're suitable to become a trader. And I also know some friends of mine, the way they run companies, they pass them a test, require them to do some mathematical calculation, Q&A, and just like examination, and they will actually examine from whether you have a logic sense. Sometimes they want to detect whether you think logically, so they will issue you some question, or the most easiest requirement is you bring your statement. If you have a statement, that's why sometimes trading requires some capital. But if you don't have capital, how to trade? So I'll say it is always chicken and egg thing. Start small. Start with your own money. Build a trades records. let's say, for example, if you can make 1% per month, so put up 10,000. 10,000, 1% per month is 100 ringgit only. So if you can make 100 ringgit per month, do it 12 months, do it 24 months. These segments of 12 or 24 months with 1%, 100 ringgit every month, if you shows to this kind of prop owner, they may probably, or bank, they probably just pick you up and hire you. Yes, this is the best result or the best qualification that you have. Then you don't need the requirement to have degree in this sort of thing. Straight away, your statements says it all.
Okay, now, is there any app or website we can view the features of SCPO and the KLCI live technical chart?
As far as I know, tradingview.com, they do have this. In Malaysia, there's the number of pay subscription which you have more contracts to view. But TradingView, I think most people will use TradingView. I'm not sure about Ting or Stream, but TradingView, I seen they have this. There's another software called Wenhua. Wenhua.com also, they have this kind of feature which they have app version, they have also PC versions. TradingView, I think even better. Investing also they have. Yeah, there are so many nowadays. And last time you had to pay a lot to acquire something like this.
I use Bursa Station.
Yeah, Bursa Station is a pay version. I mean, do they have free version for viewing the data?
They don't. They don't.
Ah,
But I use Bursa Station. So if you want the paid software, you can subscribe to Bursa Stations. Okay. So last question. In futures trading, how long is usually the holding period?
Well, this depends on which time frame you're trading. We talk about okay, in trading futures in Malaysia, there's few type of people. One is intraday scalper. So usually the local participant, the full-time traders that I know, they are trading scalping means you enter, you take profit 1, 2, 3 ticks, you get out. So these are local participants. So they want to get out as fast as possible. So and those really trading intraday, they have 0 position overnight. So that means they'll get in, they'll get out by the day end. So there's no position hold at all. So this we call intraday scalpers. A lot of full-time traders are like that, trading outright. Another type is actually spread trading. Spread trading, then spread trading, scalping, sometimes one day you cannot get out. Let's say you want to make 2 points, you can't. So you need to carry overnight, 1 to 2 days. For spread scalping, okay, then you are talking about 1 to 2 days at least, of course minimum is the same day we get out, okay, if the market is active. But spread trading sometimes is not active. So outright traders, scalper, intraday only. Spread trading, scalper, 1 to 3 days. For CPO swing trading, that means they trade a small swing. So usually 3 to 5 days discount and entry and exit. Of course, swing trading, you can sometimes take a bigger swing after everything is possible. For spread swing trading, you actually look at something. To me, it will be something like a week plus kind of thing. So maximum, let's say for example, our whole position for longer term for spread, I could have hold like for 1 month. But usually, if I hold position for 1 month, means my entry is not good. That means I'm losing money. So I'm holding position to repair the position. So it takes me 1 month up to 2 months to get out my position. So this is my maximum usually kind of position. So I in futures I don't hold like years, to get it mature, because as I said, the number of trades is your risk. If you have a trade set, it works for you buy and sell in 1 year time, so you make a lot. But problem is that you couldn't test it, because to test 10 times you need 10 years. So you don't have the 10 years to test, to have the confidence to go in substantial size. So for us, we get out as soon as we profitable, reach the target that I wanted to. So the time frame can be very, very short. Intraday, we hold 0 position for scalping, but maximum I can hold up to one month plus. But usually it's losing position.
Okay, yeah, interesting for scalping, even though on spread is a few days.
Yeah.
Okay. Now, well, we have come to the end of the webinars today. So let me go to our next webinar. Okay, our next webinar is called the Psychology in Trading in the Futures Market. So it will happen on 22nd of August, which is a Thursday. The time is 8:30 to 10 o'clock. So the registration link is as below and it has been shared with you on the chat group. So please go to the chat group right now to click on the link to register. In this webinar, you're going to learn about how you can maintain a good state of mind when it comes to trading futures. Now, in my opinion, having the right state of mind is really important in trading. Do you agree, CC?
Yes, definitely. This
Yeah.
is crucial.
Very crucial as the risk management. So today
Yes.
we shared about risk management, some of the principles there, and some tactics like measuring your own winning probability and the risk reward ratio. In the next webinar, we're going to talk about how we can maintain a winning mindset and how we can control your emotions when it comes to trading in the futures market. So with that, thank you very much, CC Yong, for spending your pleasant evening with us to share with us what
You're
is
welcome.
your view in the risk management. And I also want to thank all of you for tuning in today to learn about risk management for us now. This webinar is organized by LifeChamp and brought to you by Bursa Malaysia Derivative. And this is Chen Chook signing off, and see you all again in the next webinar. Bye bye.